G'day expats and welcome to another episode of Expat Chat, episode 119. God, we're getting up there now, which is terrific. As always, I'm joined with my co-host, Brett Evans, colleague, friend, mentor, the founder of Atlas Wealth Management and currently the managing director of the Europe, Middle East and Africa's region. We are back from summer. How are you, Brett?
Mate, all well here, thanks. A lot going on in this land, and we'll update everyone on the podcast. And also for the folks out there who don't recognise the silky smooth tunes of Mr. James Ridley, joined by my mate and the guru from the APAC region who runs the Australian office, James Ridley, who has just recently been married, has just returned from his honeymoon. Do not look at his Instagram; it'll make you absolutely sick with all the locations he went to in Italy. Hey, welcome back and congratulations on the nuptials.
Thank you, mate. I'm a bit rusty talking on a podcast. It's definitely been a minute, so I do apologise to our listeners if I guess have a bit of verbal diarrhea or put my foot in it. But yeah, it's great to be back. Italy was great. Wedding was great. All went very well. We got very lucky with the weather, and I can't really say anything bad about Italy. I love it, to be honest. Love Tuscany. We went to Montepulciano up in Tuscany for a couple of nights. We sort of went all over. So we went to Milan.
The Dolomites.
Dolomites. Oh, they're insane. And then we did some of the coastal towns, Cinque Terre, Lake Garda. We did go to Italy the year prior, so we're sort of doing all the other spots that we didn't get to last year. But we just got so lucky with the weather. It was just I don't know, quintessential sort of European summer, like 30 to 35 degree days and just, blue
Cruising
skies.
around.
Yeah,
No,
exactly. Mate.
Jealous, very jealous sitting here in the sandpit watching all that. And to the folks out there who've been sending messages and people have been talking on calls, we're back. Lots happened over the last 2 months. Obviously we had the massive rush up into the end of financial year. Obviously the summer season when everyone gets the hell out of Dodge here in the Middle East. But we've also had a number of new bodies join us since we last had a chat. So in the Dubai office here, there's now 7 strong. We've got Leanne, who's over my shoulder, just sitting right there. She's joining Justine as a client service officer. And we've also got Joelle, who's joined us as our marketing communications manager. So with everything we're trying to do here at Atlas for expats, it's all about conversations at scale. And Joe's got to be an amazing asset for us in terms of really getting the education side of managing your finances out there to expats wherever they are. So keep an eye out. You'll see our newsletter, socials, everything's going to get very busy very quickly. We've already got a webinar happening this month, with
this month, mate.
Jeremy and Jack Henderson from Henderson Advisory, which is great. Next month, we'll have our masterclass roadshow, and that's going to be in Dubai, Abu Dhabi, and Riyadh. So that's fantastic. We're going to have Ben Turner, Jeremy, and James himself over here, which is fantastic, giving you the cook's tour of the sandpit. And that's just the next 2 months. There's a lot planned for the next 12 months. Joe's been crazy planning everything out to 2025. So guys, if you enjoy our content, if you enjoy listening to the dulcet tones of James and I and my colleagues talk, you get to hear more of it. So hopefully that's in everyone's favour. But mate, let's just quickly tick some boxes from a compliance point of view and keep the compliance officers of the world happy out there. All the information that we're going to talk about today is for educational and informational purposes only. Please do not construe this as personal advice. If you do need to get personal advice, speak to a specialist like Atlas.
Absolutely, mate. And I mean, we've got a great episode today. And what we're doing is running through a bit of Q&A from our terrific Facebook group. So if you're not in our Facebook group, ladies and gentlemen, please do jump on there. It's called the Australian Expat Financial Forum. If you're overseas, you want to throw in questions, it's a terrific community and it's growing every day. And it's often the case that you've got a similar query problem that you're trying to deal with, but that person or that same expat, they're in the US or they're in Singapore and, you're in the Middle East, and you can definitely help yourself. So it's really great to see everyone, I suppose, bouncing ideas off each other and helping as well. That's what we love about that community spirit in the Australian expat space. But a bit of Q&A today that we're going to run through. And I might just jump straight into it.
Please do.
I'll kick us off. Good good one here from Brody. I won't drop surnames, but I'm not sure if I'm allowed to, so I'll just start with first names. But some good questions here from Brody. So, when depending on what country you're in and setting up accounts for different exchange platforms, um, if you're if you're not wanting to, I suppose, interfere with your tax residency, should you be really drilling down and considering if you're going to set up, say, a currency platform and you're based in, say, Saudi Arabia, should you be setting up a currency platform in Australia, or should you be setting up an account on a currency platform out of Saudi Arabia? And will that have an impact on your tax residency? I mean, it's a good question, but we're just talking about an FX rate account here, aren't we?
Look, I think it's there's a lot to it, these sort of things, and there's the marketing pitch that a lot of platforms, overseas platforms use, that they sort of
Mm,
scare expats. Then there's
mm,
the compliance issues that a lot of folks have with setting up accounts and um, being able to access an account and open an account and make transfers. Obviously,
hmm.
Saudi riyals is different from US dollars, so the
It is.
platform you choose to use will be a little bit different.
Yep,
The strategy most of our clients have done in terms of getting reals into dollars, Australian dollars, that is, as everyone has a US dollar account in their
that's
Saudi
right.
bank account. Yes, you'll take a clip when you move from reals to US dollars, but then you can transfer US dollars to OFX or WISE or currency transfer and move the money back to Oz. So to
That's right.
me, coming back to Brody's point, obviously you don't want to interfere with tax residency, withholding tax and stuff. So withholding tax, you might be talking about now about investment portfolios. So that will have an issue in terms of who you use. A lot of people will try and take the shortcut of using a ComSec account, which he does talk about at the end there.
Hmm.
Stake accounts as well too. They do create issues because they
Mm,
will not let a client, in this case Saudi, but most countries, ComSec would not allow you to have an account. So
oh
people
yeah,
go, oh, I'll just get my brother's address or my parents' address. Guess what? Being, no withholding tax has been withheld. And then you got to start having to
that's right.
file tax returns, which you might spend $500 declaring $50 worth of non-resident withholding tax. So it's
Yep.
negative economics. So don't
Yeah.
don't take that shortcut to
No,
try and sidestep that. Um,
no.
I think the other thing as well too is people often think, oh, I'm just going to go to an IBKR, interactive brokers, which
Yeah,
sometimes can be going from the frying pan to the fire. When you
yeah.
do an IBKR account, now you're subject to Uncle Sam and his recalcitrant tax laws. The one that folks that don't realise that, and that is the real stinger, is estate planning tax in the US. Even if you've
Yes.
never set foot in the United States before in your life, have no plans to, you have a joint account over there with your husband or wife, and something happens to you and you have greater than US $60,000 balance, and
Mm,
the IRS classifies that account as a US citizen account, a situated in a US account. Guess what? Something happens to you, 40% of your balance
yeah.
goes to Uncle Sam. Thank you very much for your donation. Um, Kamala and Donald will, surely put those funds to good use. So it is really important to do a deep dive in terms of what accounts you use, not so much from a tax residency point of view, but from a tax point of view.
Yeah, I mean, residency, it's something that it's still up in the air, isn't it? We haven't heard anything from the government on that one. Hopefully, when it comes time to our masterclass next month, there'll be some updates coming from Ben. So stay tuned for that one.
I think
Let's move on to.
actually
Oh,
just
sorry,
one thing
mate,
I
you go.
was going to say though, you need to keep in mind, and you touch on a very good point in terms of the new residency rules coming down the track.
Yes. Yep.
Shares, managed funds, ETFs classified as non-taxable Australian property.
Non-tap.
So
Yep.
that won't have an effect on domicile.
Right.
However,
That's right.
people looking at buying property will be caught or clawed into the new rules because it is an economic asset under the factor
That's
tests.
right. The
And
economic interest. That's
but
right.
look, let's not get down that rabbit hole. Let's move on to other
Yep.
questions, and we can go into a deeper dive in future episodes.
Absolutely. I mean, we'll touch on Sarah's question here about can you have a UK SIPP if no longer a UK resident? I mean, I'll tackle this one, Brett.
Yep.
A UK SIPP for our listeners is actually just a type of pension account. It's not too common, to be honest, in the UK. Usually you would have set it up yourself, to be honest. It's not automatically set up for you. Often you've got maybe a defined contribution plan type pension, similar to a super fund actually, back in Australia, as typical sort of industry or retail super fund. So usually you would have set up a UK SIPP yourself. So you can technically have a UK SIPP if you set it up whilst you're in the UK and living there. I reckon you'd find it maybe hard to set up by yourself if you're no longer there, but often we need a UK SIPP if we are going to try and transfer the UK pension back to Australia. But there are some criteria for that one. There's some really strict criteria on that one. So yes, if you're no longer a UK resident, you can have a UK SIPP, absolutely. But it might be hard to set it up by yourself if you're no longer living there. So that's my answer on that part. What about you, Brent?
It's spot on, as always. Yes, you can have one. Whether you have one or not is the other question, as you say. Sometimes clients will want to tread between the UK and Australia, so they'll want to have a Australian super fund and a UK pension fund. And if you do want to control it yourself, that's exactly what SIPP stands for. It is a abbreviation of self-directed. So you're actually like an SMSF, you're your own trustee and beneficiary in that regard. So can you have one? Yep. Should you have one? That's a whole nother episode that we will probably go into on a future date of time.
Absolutely, mate. And next question from Sean. Can I buy property with finance, so with a loan, in a self-managed super fund if I'm currently living overseas? Good question. Kicking over to you, Brett.
Very similar to Sarah's answer. Yes, you can, but would you know? And the reason being is, say, 1 in 40 SMSFs we see are compliant as far as the ATO is concerned. The other 39 of those 40 are not compliant. The problem that people face is central management control and active members test. So let's run through Sean's scenario here, which is a great jumping off point to talk about some other issues that I see cropping up all the time. Can you buy a property with finance and SMSF as an expat? You can set up an SMSF. You can get a loan. You can buy a property. The whole premise of you buying that property and getting a loan is you're going to have to feed the self-managed super fund in order to make your repayments. If you were to put money into a self-managed super fund as a non-resident, it is a breach of the active members test, and then you'll lose 46% of the balance because your fund will be non-compliant. So then people go, well, I won't make contributions. How much money is in your account? Can it afford, how much cash is there to make your repayments? And most people go, oh, yeah, that doesn't work. So
you take it a step. You can even take it a step further. Remember, the lender wants to see income going into that super, such as contributions, so they can make sure that, you can pay for the property and they're happy to finance you that loan. If you don't have that happening, you're going to be in a situation where you've gone ahead, you've set up an SMSF, you put your super in there, but you can't get finance at all. So now you're like, oh, crap, now I need to wind this thing up, go back and just put it in the standard retail super fund because I'm an expat. So it's a tough one. But the hardest thing will be getting finance if you're not actually having any contributions in there, as well as you can't contribute to it because you breach the active members test because you're a non-resident. So it's a funny one, though.
Yeah, central management control, active members test, the two things that bring expats undone. And the ATO is getting very serious about this. And this is not just you and I paying lip service to it. I was on a call about 3 weeks ago with a client, and the ATO called them up because they knew that the client was overseas at the 18-month mark of being overseas and demanded they wind up their SMSF immediately. Wow. Even though they've got 2 years under the temporary absence rule, they still had another 6 months to go. ATO didn't care. They demanded it. And the client had a good conversation with them. That person was nice. And they're like, so you're recommending this? No. You must wind this up now. If you have no intention of returning to Australia, you must wind this up now. People out there go, well, how do we get around this? The extreme answer is find family members and friends and everyone lumps their super into one. And as long as you don't have greater than 50% of the interest in an SMSF, you're fine, because control is in Australia, as long as those other people are Australian tax residents. So if you want to go down that route, go for it. But I've never met someone else who wants to combine assets with other people when it comes to their own personal pension account.
That's right. Yeah, absolutely. We'll keep going. A good question here from Cameron, actually. A bit of a long one. and it's mainly around the changes that have come through out of the UK, and it's to do with the changes that have happened with the concept of domicile. So over in the UK, you can have two different types of statuses. You can be domiciled or non-domiciled. There's also been a change in the inheritance tax rules over there. So Cameron's essentially saying, I suppose he's not after free advice, which he's actually said. I'm sure that Australians in the UK would appreciate any comments on how you think this may influence Australians, especially those who haven't yet filed a UK tax return like myself. I haven't summarised that too well, to be honest, but because of the changes I suppose they've brought through on non-domiciled tax status, he wants to know how should he be tackling his UK tax returns now going forward. Sounds like he's holding off. Brett, why don't you give us a bit of a summary or just some feedback in your thoughts, especially on the inheritance tax one? That's pretty important.
Look, it is in the non-dom status too, and we'll do an episode later on, more of a deep dive in this, but some of the key points, there's probably three key issues here that Australians living in the UK have to be aware of. Inheritance tax is a big one. In the past or under current rules, inheritance tax really only kicked in once you were in the UK for an amount of time, and that was 15 years. After that, then you're clawed into it. What's going to happen now is there's a bit of bait and switching going on where UK Labor have said, we're not going to tax you for the first 4 years of you being here on your worldwide income or assets. But once you cross that threshold, you're all in, baby. So I think what we're going to see is Australians in the UK shorten their time in the UK to 4 years. If you're looking at saying for 5, you'll go for 4. The other big one too is this, as he said, the non-dom status, which is very beneficial to a lot of folks. So non-dom status is virtually you're not bringing assets into the country. You're not taxed on those assets. Any assets you've got in the country, you're taxed on it. Now they're looking at getting rid of that. So that's probably the two big ones that we're doing. And actually, I was just finished writing a blog article yesterday on that, which will be going out on our website at aswealth.com, and you'll also see it on our socials. So have a look at Facebook, LinkedIn, Instagram, and X as well too. So that'll be all going on those channels. But long story short, there is a lot of change going on for UK-based Australian expats.
Yeah, absolutely. We'll keep moving on. Another question here from Linda that threw it into the group. In Australia, working with no house in either, what happens tax-wise? Might be chasing the summers there. So what happens with tax-wise and Medicare? I'm a citizen of both countries. Any advice will be appreciated. Well, I guess where you're a tax resident and what happens with Medicare? No house. So no permanent place of abode. That's an interesting one. And I guess that is really chasing the seasons maybe. I mean, you can't, you always have to be a tax resident of, I guess, one country. If you're chopping and changing 6 months at a time, I think you'd find it very difficult to make a strong case to be probably a non-resident of Australia because it's only 6 months. And the fact that you're coming back and forth, and I think if the ATO saw that you're coming back every year for 6 months, I think you'd be continued to be treated as an Australian tax resident. So you'd still be able to technically use Medicare. I think it's a case where you need a good accountant to probably make sure that tax credits are used correctly based on your income. If you're earning income in the UK, but you're still treated as an Australian tax resident, well, the tax that you're paying to the HMRC can then be used to offset some tax on the Australian side. And it could be a case where it works the same way with the UK. It's an interesting one, that one.
Look, it is, and I think it's going to be a case of you'll be, from a filing point of view, a tax resident of both countries, and you'll file and then cross over with the DTO between the two. Obviously, Medicare, as you say, James, and actually one of the other articles I wrote yesterday was actually talking about Medicare and not smoke and mirrors, actually citing government legislation in terms of how you qualify for Medicare, the specific articles. And it is one of the key points is you're ordinarily resident of Australia, amongst all the other things. So you have to be a resident of Australia. Resident of Australia, and you're there for greater than 6 months, the ATO will deem you as a tax resident, therefore you're a resident. So Medicare won't be an issue, but obviously the NHS is a very peculiar little beast that the British are very proud of. in the early days. These days, not so much. It's sort of
Oh, it
seems to be
sucks.
it's falling apart at the seams. But when it first
Yeah.
came out, it was amazing.
Yeah.
But you will have to, and look, we don't pretend to be NHS experts, so I'd
No.
recommend you have a chat to someone in the UK about your eligibility for the NHS. Obviously, there's a social security agreement between Australia
Mm,
and the UK, so
that's
which
right.
means that if you're eligible for Medicare, you can use the NHS. But how that actually works in a practical sense of fronting up to a hospital and saying, "Oh, here's my Medicare card," I'm not sure. I've never
Yeah,
been there before, but
yeah, I
look in.
know. It, I agree with you on that one. I think they'd probably look at you, scratch their head and go, "What is that?"
Yeah.
Feel like you have to take the bill back to Medicare to get some sort of rebate. Um, we'll do one more question. And
Okay.
it's a good one actually. It's around property. So if you are an Australian and own an investment property, then become a foreign tax resident, so a non-resident, for a period of time before returning to Australia and becoming an Australian tax resident again, are you able to claim the 50% CGT discount when the property is sold, or is it prorated for the time you were a foreign tax resident? That's part one. Um, and then, oh no, that's actually the main question. Um, so that's a really good question. And I still come across a lot of Australians that are either heading overseas or they're overseas, and there is an assumption there. But I'm happy to answer this question if you want, Brett.
Hey, go for it.
Yeah, so the discount is prorated based on your period of ownership and you being an Australian tax resident. So if I own a property in total for 10 years, and for 5 years, I owned it as an Australian tax resident. And then for the other 5 years, I owned it as a non-resident. Then you only get to apply that 50% CG discount for essentially half the period of ownership. Just bear in mind that they did remove the 50% CGT discount concession in May back in 2012. So regardless, if you bought a property in 2003, and you moved overseas in 2003 and became a non-resident, you're actually still entitled to the discount up until May 2012, the 8th of May 2012. You get to apply the 50% CGT discount concession all the way up until that date. So that's when market valuations can be handy rather than using the day of ownership. Market valuations usually come in a lot more favourable. And essentially, you need to prorata that discount based on you being a tax resident.
Definitely, mate. Spot on. And I think it's the big thing that often people buy properties, the people they're seeking information from have a conflict of interest. They'll tell you what they
Yep.
want just to get you to buy the property because that person wants the commission. You
Yep.
need to do a bit more homework. And we often find it's the property spruikers and those who are doing the tours promoting property ownership in Australia. They're not advisors. They're not tax experts. They've got a license to sell property. That's it. And they don't have a best interest duty to you. Once you buy that property, whatever happens after that fact, it's on you. You can't go back to them saying, "Oh, you didn't tell me about this tax." So just be careful, guys, because as James said, if you buy a property while you're overseas, that period of time never leaves you. It's like a bad smell. So even if you have it for 5 years as an expat, move back to Australia for 15 years, that 5 years will still be factored into those CGT calculations when you return. So just be careful of that. But yeah, couldn't have said any better myself. It does and it always will be there as part of your considerations when looking to sell Australian property, whether you've been an expat for the beginning, the middle, or the end.
Absolutely, absolutely. And it's just, it's one of those things. I mean, we'll see over the next 10, 15, 20 years how many other things that the Australian government ATO take away from Australian citizens while they live
Mm.
overseas.
Yeah, look, I mean, I think you read the tea leaves. It's all physical, and they're okay with digital. So,
Yeah.
and more so states as well too. Now that Victoria's broke, Sydney's almost broke, and Queensland's on the way there. I think you'll see very much a Victorian-style approach to land tax sweeping up the eastern seaboard because all the other governments will see how easy it is to make extra money for doing nothing, no work extra, and paying for their mistakes. So
Oh,
just to keep an eye on
but
that. We've got a Queensland election happening. Is it October or November this year? So
come
yeah,
through.
there's going to be lots of stuff going on there. So
Oh,
watch
yeah.
that space. And as I said, the
Absolutely,
other
mate.
thing, the point too was obviously just keep in mind the new proposed tax residency laws because for those folks out there who haven't owned property That affords you a high degree of flexibility under the new proposed laws. If you do own property in Australia and you breach a day count, then it could be expensive depending on what country of residence you're in.
Yeah, I know the Australian economic interests. It's a bit of well, that one's not a catch-all. I mean, the citizenship and residency is, but God, they really need to flesh out what's under these proposed tax residency rules. We're yet to hear back from them after they opened it up for consultation, being very coy. So hopefully in the next 6 months we get an update, maybe as soon as next month.
Yeah, look, it's been, I think we may not even see something because an Australian federal elections between October and May, anytime
That's right.
between that period. So whether Labor's going to have their hands full, trying to deal with all the bushfires they're trying to put out right now with respect to all the problems that they've got, whether they put this in the back burner, if they get re-elected, it might come out in the May budget next year, or as I say, it could come out next month. You just don't know with politicians, the old saying about how do you know when one's lying? The lips are moving. So that's how we treat it.
Yep, absolutely, mate. And that's probably a good point there to finish up today's episode. Keep an eye on the socials. As we said just before, a lot of these questions do come from the Australian Expat Financial Forum, which is a lovely community that we run on Facebook. It's growing every day. Some great comments in there, some great questions that everyone throws in there, and it's just great to see the community helping each other out.
Yeah, look, 3,000 members, I think it is, or like it's, if it's not there, it's close to it. So
No, it is. It's just over 3,000.
Okay, there we go. I thought it'd be a good guess. So, all right, guys, we'll leave it there. Good to be back. Glad to be invading your earbuds, and we'll see you next week on the next episode.
Sounds good. Thanks, guys. Thanks for tuning in. Thanks, Brett.
Thanks, guys. Take care.